This is what a market dislocation looks like when you strip away the commentary and just follow the receipts. Left side, COMEX warehouse data, the actual delivery system for silver futures. Registered inventory down 38% in 4 months. Right side, price action, silver up 85% over the same window. Here's the contradiction that doesn't make sense. While inventories are collapsing and prices are surging, the companies that actually mine this metal, the ones sitting on proven reserves in the ground, are trading as if absolutely nothing has changed. We're 18 days away from March 1st notice day. That's when holders of March futures contracts can demand physical delivery, and the numbers don't add up. This is Global Money Report. We don't trade narratives, we follow transaction data. What you're about to see isn't a prediction, and it's not a sales pitch. It's documentation. We're going to walk through 5 receipts, 5 pieces of exchange-reported, publicly verifiable data that show the physical silver market is under structural pressure that hasn't been resolved. You read the end, you'll know exactly which metrics to track, where to find the data yourself, and what signals to watch as we approach February 27th, the date that may determine whether the paper silver market maintains credibility. Receipt number 1. COMEX Warehouse Reports. These come directly from CME Group, the entity that operates the exchange. They publish this data every business day. 2 categories matter here. Registered silver is metal that's been delivered onto the exchange and is available to satisfy futures contract delivery. Eligible silver is metal, sitting in approved warehouses but not pledged for delivery. It belongs to someone and they're just using the vault for storage. On October 15th, 2025, COMEX registered inventory stood at 167.7 million ounces. As of February 5th, 2026, less than 4 months later, that figure is down to 103.5 million ounces. That's a 38% decline. The drainage rate over the past 2 months has accelerated to roughly 785,000 ounces per day. If, and this is just arithmetic, if that drainage rate continues through February 27th, which is 21 days from today, you're looking at approximately 85 million ounces remaining when the March delivery window opens. Now compare that to the open interest in the March 2026 silver contract. Current open interest represents approximately 429 million ounces in notional value. Historically, most futures traders don't stand for delivery. They roll their positions forward or close them out before expiration. A typical delivery rate might be 5 to 15% in a major month. But we're not in typical conditions anymore. In January 2026, which is classified as a minor delivery month, the delivery rate was 98%. Out of 19.11 million ounces of open interest, 18.72 million ounces were called for physical delivery. That's not a futures market, that's a physical allocation mechanism. Receipt number 2. London silver lease rates. This data comes from the London Bullion Market Association and the Japan Bullion Market Association. These are the rates that bullion banks charge to lend silver to industrial users or other market participants who need to borrow metal. Under normal market conditions, 1-month silver lease rates sit below 1% annually. It's a quiet, liquid lending market. As recently as July 2025, the 1-month rate was around 6%. Elevated but manageable. On October 9, 2025, the 1-month lease rate spiked to 39%. Let me say that again for emphasis. 39% annually to borrow silver for 30 days. That's not a financing cost. That's a distress signal. The rate has moderated since then, but as of early February 2026, 1-month lease rates are still running between 8 and 12%, which is still 10 to 12 times higher than normal. What does a lease rate spike tell you? It means people who have silver are unwilling to lend it, even at dramatically higher interest rates. It means demand for physical borrowing is overwhelming available supply. There have only been 2 other periods in modern history where silver lease rates sustained levels this high. One was 1979 to 1980 during the Hunt brothers accumulation, when silver ultimately rose from $6 to $50 per ounce. The other was March to April 2020 during the COVID supply chain disruption when silver jumped from $12 to $30 within 6 months. The current lease rate environment has persisted longer than either of those prior episodes. Receipt number 3. The silver futures curve. In a normally functioning commodity market, futures contracts further out in time trade at a premium to nearby contracts. This is called contango. It reflects the cost of storage, insurance, and financing. If you're storing silver for 6 months, there are costs associated with that. So the 6-month contract should logically be priced slightly higher than the spot price or the 1-month contract. Starting in late 2025, the silver curve inverted. Near-term contracts began trading at a premium to deferred contracts. This condition is called backwardation. As of early February, the December 2025 contract is trading at a premium to the March 2026 contract. Spot silver in some markets is trading above 3-month and 6-month futures. What does backwardation signal? It means the market is willing to pay more for silver you can deliver today than for silver promised months from now. It's a vote of no confidence in the future availability of physical metal. According to data from Bank of America and other institutions tracking the futures curve, the current degree of backwardation in silver is the deepest since the early 1980s. When backwardation appeared in 2011, silver rallied from $26 to $49 in less than 8 months. When it appeared in 2020, silver moved 45% in the following quarter. Backwardation doesn't predict future prices, but it does tell you that physical supply is under immediate stress. Receipt number 4. Regional price fragmentation. In a globally integrated market, prices for the same commodity should converge across regions. If silver is cheaper in New York than in Shanghai, arbitrageurs should buy in New York, ship it to Shanghai, and sell for a profit. This activity compresses the price gap. That mechanism is breaking down. As of early February 2026, physical silver on the Shanghai Gold Exchange is trading at a premium of approximately 12 to 13% above LBMA spot pricing and COMEX futures. A premium of that magnitude is exceptional. For context, during the COVID supply disruption in 2020, Shanghai premiums peaked around 8%. We're now 50% higher than that peak. It's not just China. Japan's retail secondary markets, platforms like Mercari, have seen premiums surge to 60% at times. Dubai, India, and other Asian markets are all showing elevated premiums for physical metal. Why isn't arbitrage closing these gaps? 3 reasons. First, there isn't enough available metal in Western vaults to ship. The inventory we showed you earlier, that's metal that's already spoken for or physically constrained. Second, elevated lease rates mean the cost of borrowing silver to execute the arbitrage trade has become prohibitively expensive. Third, logistical constraints and refining specifications mean you can't just move any silver bar from one market to another instantly. When regional price fragmentation persists at these levels, it signals that the global physical market is no longer functioning as a unified system. You're seeing the early stages of market segmentation. Receipt number 5. The World Silver Survey. Published by the Silver Institute and prepared by Metals Focus. This is the industry's authoritative annual supply and demand accounting. For 5 consecutive years, the silver market has run a structural deficit. Demand has exceeded newly mined supply plus recycling. The cumulative deficit over those 5 years totals approximately 820 million ounces. To put that in perspective, global mine production in 2024 was 819.7 million ounces. The accumulated deficit is equivalent to an entire year of global mining output. Where is this deficit showing up? Industrial demand hit a record 680.5 million ounces in 2024. That's being driven primarily by solar panel manufacturing, now consuming 230 million ounces annually, up from just 60 million ounces in 2015. Electronics, electric vehicles, medical applications, these are not discretionary uses. You cannot build a solar cell without silver paste. The conductivity requirements don't allow for substitution at current technology levels. Where is the deficit being filled from? Above-ground inventories, exchange-traded products, central bank holdings, private vaults? When a market runs persistent structural deficits, the question becomes, how long can inventory drawdowns continue before something breaks? 5 years is not a temporary mismatch. This is structural, and we're now in year 6. Let's connect these 5 receipts. You have inventories draining at COMEX. You have lease rates signaling unwillingness to lend. You have backwardation showing preference for immediate delivery. You have regional markets fragmenting with massive premiums. And you have 5 years of structural deficits depleting above-ground stocks. These are not separate stories. They're the same story told from different angles. Now here's where the mining stocks enter the picture. Silver has moved from roughly $27 per ounce in early 2025 to the $45 to $50 range in early 2026. That's a doubling in 12 months. Primary silver mining companies, the ones for whom silver is the main product, have seen their stock prices rise, but they're lagging the metal by a significant margin. Many are up 30 to 60%, while silver itself has doubled. Why does this lag exist? The market is pricing in reversion. Investors and algorithms are betting that silver will fall back to $30 to $35, so they're not willing to pay full value for mining cash flows based on $45 to $50 silver. But look at the operational leverage. According to Silver Institute data, the average all-in sustaining cost for primary silver miners in the first half of 2025 was $13 per ounce. Actually the lowest in several years due to operational efficiencies. Let's be conservative and assume costs have risen slightly to $15 per ounce by early 2026. At $30 silver, a miner with $15 costs earns a $15 margin per ounce. At $50 silver, that same miner earns a $35 margin per ounce. The metal price increased 67%. The margin per ounce increased 133%. That's operational gearing. If the 5 receipts we just documented are correct, if this is a structural supply problem and not a temporary speculative mania, then mining companies are going to report cash generation in the coming quarters that will force market repricing. Here's what you can track yourself. These are the 3 metrics that matter between now and March 1st notice, day on February 27th. Metric 1. COMEX registered inventory. CME Group publishes daily warehouse stock reports. You want to watch the registered silver category specifically. The current level is around 103 million ounces as of February 5th. What to watch for if registered inventory drops below 90 million ounces before February 27th and March open interest remains above 400 million ounces, the coverage ratio becomes critical. You can find this data at cmegroup.com under Delivery Reports, or track it via sites like heavymetalstats.com, which aggregate the data visually. Metric 2. Silver lease rates. These are reported by LBMA and tracked by services like Bloomberg and Japan Bullion Market Association. Current 1-month rates are running 8 to 12%. What to watch for? If lease rates spike back above 20%, it means lending stress is intensifying. If they normalize back below 3%, it suggests physical pressure is easing. The direction matters more than the absolute level. Metric 3. Futures curve shape. You can see this on any commodity price platform, investing.com, TradingView, CME Group's own charting. Compare the March 2026 contract price to the May 2026 and July 2026 contracts. What to watch for? If backwardation deepens, meaning near contracts trade at even larger premiums to deferred contracts, physical stress is escalating. If the curve returns to contango, deferred contracts priced higher than nearby, it signals the squeeze is resolving. We've linked the data sources in the description below. You don't need to take our word for any of this. You can verify every number yourself. We opened with this contradiction. Inventories falling, prices rising, mining stocks flat. What we've shown you are 5 receipts. 5 independently verifiable data points that all point in the same direction. The physical silver market is under structural pressure. February 27th is 18 days away. That's when we find out if the paper market can deliver on its promises or if this evolves into something larger. This is Global Money Report. We follow the receipts. If you want to continue tracking the situation as it develops, subscribe to the channel. We'll be updating the data as we move toward the March delivery window. Drop a comment below with which metric you're watching most closely: inventory, lease rates, or the futures curve. Let's see what the data shows us over the next 3 weeks.